What about in the inevitable event of a return of real volatility to the market and uncertainty and fear? How do you talk to your clients differently about filtering biases and how do you coach them through that?
It has nothing to do with the turmoil of the moment. It has to do with what has happened through all the prior turmoils that have occurred and what happened following that. It's not an L. That's not how the markets work. They are U's or V's, sometimes W's, but they're never L's. So I don't care if the market goes down 20%. I want to know what happens after that. And that's what the media doesn't talk about. It's what consumers don't talk about. They're fearful of the drop, and they don't realize this too shall pass.
The main point I find about a lot of these events is that the biggest thing that happens is a big cloud of uncertainty bursts open. And one of the things you know is that if you analyze a problem, and it doesn't look like it really changed very much, probably, but you had a lot of uncertainty, the one thing that changes every day is the uncertainty goes down.
The typical 35-year-old today has less money invested in stocks than a 65-year-old.
Right.
Because a 35-year-old, their entire adult life, this 35-year-old graduated college in the year 2000, experienced the tech market bubble bursting, then 9/11, then 08, and all the political turmoil ever since, and terrorism and all that kind of stuff. They have no confidence in the stock market. The 65-year-old remembers the crash of 87 and the recession in 94 and all the other stuff and says, you know what, I've learned, all I got to do is wait.
The important thing is just having a structure in which you can say, look, this thing happened, but here's how we'd analyze it. Here's a logical way of organizing it in your mind so you can make a rational decision about this rather than an emotional one.
It's not a reaction. It's preparation in advance. It's, clients giving them a long-term plan and a structure. And here's what we would do. If the market gave us an opportunity to rebalance, we would do that. Educate your clients on the things that you advise them not to do, not just what you advise them to do. Because most of the time, clients that take our advice avoid landmines or avoid doing something that they haven't fully vetted. And I think that, that kind of protection and that kind of alignment with the client is so important, but it's underestimated.
Yeah, let's see. How does this, in your opinion, manifest in the mistakes people make in terms of misuse of misunderstanding?
The first mistake is that I'm often asked questions on the media, well, how are you trading this market? I'm not trading this market. There's a very small percentage of people who make their living trading. The vast majority of people need to be long-term investors. And as a long-term investor, you have two enormous advantages over traders. First of all, you can have a diversified portfolio. It's not about what one stock does over the next 24 hours. It's about what our whole portfolio of global investments do. And the second thing is that the odd thing about investing is that it's kind of like the difference between forecasting the weather and understanding the climate. And for an investor, it's important to realize that you can't tell what the market's going to do day to day, week to week, but over 5 years, 10 years...
But the media is constantly pretending that it can.
Yes.
And that's the problem.
Because if you ran a long-term investment show, you could run it once a year and you'd have to fill the other 364 days with the Weather Channel.